We're an incredibly attractive macro environment for investing in opportunistic debt. Ultimately, what's happened over the last 12, 18 months with a material rise in interest rates, as well as a bit of liquidity getting pulled out of the system as a result, means that there's not the array of capital providers in the marketplace throwing large amounts of capital at potential investee companies. And so they're a lot more open for innovative structures and basically just having to pay a higher cost of capital. We expect the environment that we're going to be in at the moment to last for at least another 2 to 3 years. But those strong double-digit returns that we've consistently generated over time, the pipeline of investments that we are currently investing in and can see going for a long period of time, we expect will be consistent with generating those very, very strong low double-digit returns with a high degree of confidence around limited capital loss. We don't like losing money. We never want to lose money on investments we make, and ultimately that comes down to the quality of the counterparty, the quality of the assets, the quality of the cash flow streams that you're investing into, and in our instances we're lending to. And the North Star is an assiduous process that understands industry structure, understands company or asset componentry, understands management, people, and understands basically security position. What can we get our hands on if things go wrong? And then finally, we take those commercial frameworks and we apply that into deep legal documentation, which are the loan documents, that give us very, very strong security rights and protections to ensure that we get a return of our capital and the ability to take necessary steps to get a return on our capital, and the return on our capital that the loan documents stipulate. What that ultimately is talking about is for our clients, we offer them a portfolio of investments. So when you invest in our fund, you're exposed to 20, 30 different loans. And what we want to think about, not just that each individual loan is highly secure and very attractive in its rate of return that it's generating, and that's typically double digit. But not only that, but when we put those together as a collective, we're not always investing or betting on the same thematic. So we place limits on the amount of exposure we have to a single sector, to a single geography, to a single counterparty, and then over and above that, we think about, well, what other factors or what other elements might become through the portfolio and showing some form of consistency, be it inflationary risk, be it consumer target risk, and that's what we mean about we want to have as much diversification, or use that language, as much idiosyncratic risk in the portfolio as possible, so that if there's something that occurs like COVID or the like, that all the parts of your portfolio aren't impacted in the same way. So if the things that come out of left field, as they always do, you're benefiting from this material diversification rather than your portfolio all getting impacted in the same way by the same sort of market event. Everything we do, by and large, adds up to an equity-like return. So if you assume equities going forward will generate a high single-digit return, and capital market theory around that will sort of have equities being, if they're fairly priced today, which you can take your own view on, that they will generate a return of high single digits. Our portfolio of investments, all of them, are expected to generate double-digit returns. So the portfolio net of fees, we expect collectively will generate double-digit returns, certainly being consistent with what it's done historically, and the loan terms and the documentation that we have entered into is consistent with that rate of return, so there's a relatively high degree of confidence around why we have that expectation. And then in addition to that, where possible, we seek to negotiate equity warrants as part of our loans, and they provide an additional rate of return over and above that. We don't forecast those, but we consider those the cream on top. So, in essence, if we are expecting the portfolio to generate a net of fees return of, say, 10 to 12%, that already materially exceeds equity markets forecast, and then in addition to that, equity warrants will be potentially return over and above that again.